So the truth is, we need to have an honest discussion about what government should do, how it should do it, and who should pay for it.
Can our government keep spending the way that it has been? I mean, it can, but just as with anything, there will be consequences. Welcome back to the most fearless savers on YouTube. And for those of you who don't know me, my name is Steven Spicer. And after more than 15 years in the industry, it drives me more crazy than ever how few financial experts will rationally discuss some of the most potentially devastating risks with which today's savers are presented. For this video specifically, let's thoughtfully explore what the government's options are for funding our politicians' extravagant spending habit. It could, 1, increase taxes, 2, reduce other spending, or 3, print more money. That third option here has been their go-to for the last couple of decades, so that seems their most likely path forward. If that cash cow is still giving us milk, votes, you better not tip it over. Or whatever, that's not really saying, but you know they're thinking it, something like that. That third path there presents you, the individual saver, with the massive risk of hyperinflation. In other words, the risk that almost all of your traditional assets effectively lose their value. I've put together an entire, amazingly acted, if I may say so myself, playlist that I'll link out to for you here, which dives deep into what that could look like if we don't prepare. But anyway, the 2010 Simpson-Bowles Commission, which I explain in video 2 of that playlist, recommended to fix our fiscal problem the first two, increase taxes and reduce spending, which of course is politically unpopular. The left objected to their recommended entitlement reductions and the right to their proposed tax hike. Not that any of those who objected had anything better to propose, just good old head in the sand, pray nothing comes crashing down on your watch economics. David M. Walker was the U.S. Comptroller General from 1998 through 2008. He was effectively the USA's CPA. He knows more about the country's financial inner workings than pretty much anyone else on the planet. And ever since he left his post, he has been sounding the alarm that something will have to change. In 2011, he said, based on the current fiscal path, future tax rates will have to double, or our country could go bankrupt. A similar conclusion as the Simpson-Bowles Commission. And our fiscal situation today is far worse.
It needs to devolve some of the things the federal government's doing to state and local government. And we have to keep in mind the principles that we were founded on.
Let's dive into some of the particulars. Are you familiar with the concept of unfunded liabilities? These are the promises, the guarantees that were made by some politicians from the past and will come due at some point in the future. A lot of people like to overlook these, but they're a big deal for your financial future. Let's start with Social Security. When the Social Security Act was enacted in 1935, based on expected birth rates and life expectancies at that time, there were 42 workers paying into the Social Security system for every one person who would be receiving benefits. At that time, they made the official retirement age 65, but the average life expectancy was only 62. This was clearly set up as a safety net for an insurance against living longer than expected, and thus being at risk of outliving your savings. If you made it to 65, you would surely only be drawing on Social Security for a few years, right? But the variables have quite obviously and drastically changed. After World War II, American couples had babies like never before. Then those so-called baby boomers did not have nearly as many babies themselves. And that downward trend continues today. So over time, there are fewer and fewer working age people, the children and grandchildren of the current retirees, paying into the Social Security system. Yeah, so instead of 42 workers funding Social Security for each one person taking money out of the program, the ratio has dropped to less than 3 for every one. What other variables are different? You can now start taking benefits earlier than you could back then, 62 instead of 65. Life expectancy is way longer. Specifically, those who start taking Social Security at 62 are, on average, currently expected to live until 85, more than 20 years longer than when it was originally devised. The government will shell out about $1.5 trillion this year on Social Security benefits. That's more than 20% of the federal budget, or 30% of federal revenue. As more and more baby boomers retire, that problem is just going to keep getting worse. Ignoring it will lead to much worse inflation. Properly addressing the issue would most likely lead to much higher taxes. I put properly in quotes because I think the most proper thing to do would be for politicians to stop getting us into these messes in the first place. But we can't go back in time, and I'm not holding my breath waiting for that breed to change. So I guess this would just be the best thing that we can do with our current terrible predicament. Politicians just keep making promises without enough thought for how we are going to pay for them. These are those unfunded liabilities, or one might call them unfunded obligations, or better yet, unfunded guarantees backed by the full faith and credit of the United States, for whatever that's worth in the future. The most expensive of these unfunded guarantees is our current universal healthcare system for seniors, Medicare. Medicare suffers from the same problems as Social Security. It will cost the government $1.7 trillion this year. And due to similarly worsening variables, that figure also continues to spiral out of control. According to David Walker, on our current course, these two entitlements alone could strain the country's finances to the point of bankruptcy. You can almost visualize the can kicking when studying the Medicare trustees' annual report on how many years until money specifically allocated for Medicare will be depleted. If it gets too low, they've just got to do one of those three things above to buy us a few more years. Let's do the math ourselves. Let's add up what the government is currently on track to spend this year on its largest budget items, one of which is, sadly, interest on its massive debt load. Medicare and Medicaid is $1.7 trillion. Social Security is $1.5 trillion. Interest on national debt, $1 trillion. Defense/war, $900 billion. That's 1.7 trillion plus 1.5 trillion plus 1 trillion plus 0.9 trillion, which equals 5.1 trillion US dollars. And do you happen to know off the top of your head how much our federal revenue is currently? It's $5 trillion, just over. In other words, the United States currently spends more than 100% of every tax dollar on these 5 line items: Medicare, Medicaid, Social Security, interest, and defense. Please don't get me wrong. These are absolutely important things. I'm not saying we shouldn't have them to some extent. I don't claim to have all the political answers. That's not what this is about. What I am claiming to be able to do, as I believe any rational human should, is look at these figures and know that this is not sustainable. Additionally, I think about all the other programs the government still needs to fund with their remaining negative something percent. Can you see why the Simpson-Bowles Commission was concerned enough to recommend such politically unpopular policies? Can you see why David Walker CPA is so concerned? Can you see why I'm concerned about the implications all this has on future inflation and or taxes? Why I'm concerned about my financial future, my children's financial future, my mother's, my clients', everyone's financial future. But when it comes to taxes, how much could tax rates really go up if that's where the hit comes the hardest versus inflation? Well, historically, the amount the US government has taxed its people has varied widely. To initially get this plan through Congress,
I have to get my plan through Congress.
In 1913, income tax was only 1%. And even then, only to the most wealthy. But as you can imagine, once politicians realized what they could do with a steady stream of money coming through the door, the evil genie was out of the bottle with seemingly infinite wishes to grant and votes to grab. There was no going back. By 1943, the highest marginal tax rate was a whopping 94% for anyone with an income over $200,000. After all, the rich didn't need any more money, did they? Any more of that income that they were earning for themselves. By the 1970s, that highest rate for every dollar of income over $200,000 had fallen to 70%. How generous is our government? Let the rich keep 30 cents of every dollar that they're earning. Today, the highest tax rate is sub 40%. It looks like taxes are actually historically on the low end. It is at least undeniable that they could be worse, much worse. David McKnight, in his book Power of Zero, summarizes like this. According to the Congressional Budget Office, if Social Security, Medicare, and Medicaid go unchanged, the government could be forced to adopt a 3-bracket system in which some of your income gets taxed at 25%, some at 63%, and some at an astonishing 88%. For you skeptics out there, let me take you back in time. From 1960 through 1963, the lowest marginal tax rate was 20%, the middle tax bracket was 69%, and the highest marginal rate was an astonishing 91%. Folks, this is a path we've been down before. What's that old adage? Those who don't study history are destined to repeat it. And then Mr. McKnight shares what is probably my favorite part of that whole book, because this story, this analogy, applies so well to all the concerns that I have and I've been sharing with you here and in my book. It's so good that I think I might have to pay him the compliment of borrowing this concept and applying it to all the risks I've identified that most people, and even most financial advisors, just want to pretend aren't actually risks to them. Just hope for the best. I'll let him tell his own story here. He writes, "A few years ago, I was watching The Roadrunner with my kids. In this particular episode, Wile E. Coyote was up to his usual tactics and trying to subdue the Roadrunner. He was building a bomb, made by Acme, of course, inside a shed, also made by Acme. The Coyote was so intent upon completing the bomb that he didn't realize that the Roadrunner had pushed his shed onto a train track. What's worse, he didn't realize until the very last moment that a huge freight train was bearing down on him. Now, if you found yourself on a track with a huge train bearing down on you, what would you do? You jump off, right? Well, when the Coyote saw the huge freight train approaching, he didn't jump out of the way. He simply pulled down the window shade, thinking that the act of doing so would make the problem go away. Did the problem go away? Of course not. There was a huge explosion, and let's face it, does the Coyote ever die? No. But as the smoke cleared, we could see the Coyote limping away from the wreckage, very much worse for the wear. This story is so apropos of the 5 massive risks I guide people through in our financial doomsday survival guide. It's just a series of emails that I put together for people that breaks down all these risks and then identifies the best possible solutions we found. I'll link out to it in the description below. Anyway, this is the way most people behave. Worse, as I mentioned earlier, this is the way most advisors behave. And then people just want to trust the advisors and pass off the blame to them so they don't have to deal with it. They see and deep down understand the writing that's on the wall because it's actually kind of obvious. They see that massive tax bomb on the horizon. They see that hyperinflation risk. They see the shaky ground upon which their entire investment paradigm is built. And what do? They Wile E. Coyote it, right? They just pull down the blinds and hope for the best. It's like a petulant little boy who doesn't want to accept what his parent is telling him. He just plugs his ears and babbles, blah, blah, blah. If he can't hear what his parent's saying, it doesn't count, right? Yeah, sorry, that's just not how real life works. Once again, with this issue, I find myself lonely in the camp of wanting to be as prepared as possible. I don't want to have to worry about this massive variable that is taxes. And by the way, it's totally possible for most to entirely eliminate this risk without sacrificing upside or much of anything, really. And this one just requires some knowledge, which you'll find in great detail in that Financial Doomsday Survival Guide and in future videos on this channel, and some thoughtful planning. So yeah, don't be like Wile E. Coyote. Be among those bold few who choose to stare those freight trains down head on and thoughtfully craft a plan. You've got this. Go reply to one of those emails. I will respond. I'll see you there.